Dollar cost averaging is a common investing strategy that is thought to reduce the risks associated with investing. In this video, we're going to look at what dollar cost averaging is and whether it actually reduces the risk of investing. For example, let's say you've inherited or saved £120,000 and you want to invest it in the stock market. You might be worried about investing it all in one go. What if the market crashes the next day? Well, in that case, you would use dollar cost averaging. Instead of buying all the shares in the first month, you could split the purchases up and spread them out over the next few months or even years. So, one example would be to take your £120,000 and split it up into individual £10,000 purchases over the next 12 months. This could protect you from market crashes and short-term volatility. You'll effectively be buying the stocks for the average price over the 12-month period. You'll get more shares for your money if the market falls, but ultimately you'll have to pay more for the shares if the market rises. Instead, if you were to buy all of the shares on the first day, you would be using the lump sum investing strategy. Dollar cost averaging is thought to be less risky because it avoids making one poorly timed lump sum purchase. So, which approach would you use? The less risky dollar cost averaging or the lump sum investing? What if I told you that dollar cost averaging doesn't actually reduce the risk and is more likely to perform worse than lump sum investing? Still not convinced? Let's have a look at the research. Vanguard published an analysis of dollar cost averaging versus lump sum investing in 2012. Their analysis looked at investing over a 10-year period using both the dollar cost averaging and the lump sum investing approach. Vanguard reviewed data for the US, the UK and Australia. The performance of a portfolio of 60% stocks and 40% bonds was selected, as this was used to represent the average investor's portfolio. The dollar cost averaging occurred over a 12-month period, followed by a 9-year holding period. The lump sum investing holding period was for the full 10 years. The analysis showed that the lump sum investing outperformed the dollar cost averaging approach 67% of the time. To quote the study, lump sum investing outperformed dollar cost averaging in a greater proportion of historical time periods, regardless of the dollar cost averaging period length. This finding is consistent with the fact that the returns of stocks and bonds exceeded that of cash over our study period in each of these markets. Essentially, because stocks and bonds have a higher return than cash, the longer you hold the stocks and bonds for, the better. Dollar cost averaging just means taking risk later on. However, the research acknowledges that it doesn't take into account other factors, such as emotional decision making and having the access to large sums of capital. Lump sum investing isn't necessarily accessible to most investors. If, like me, you are adding to your portfolio with your income, then dollar cost averaging is the best option to build your wealth. This is because most salaries come in monthly, so you will likely be buying your stocks and bonds in the same monthly basis. Emotional and risk-averse investors could also consider dollar cost averaging if they feel uncomfortable with the idea of their portfolios dropping in a large amount of value just after investing. The research explains that, out of the 1,021 rolling 12-month investment periods, lump sum investing investors would have seen their portfolios decline in value during 229 periods, or 22.4% of the time, whilst dollar cost averaging investors would have seen such declines during only 180 periods, or 17.6% of the time. The allocation to cash during the dollar cost averaging period reduces the overall risk of a portfolio. It's worth understanding that the only reason for this is because holding cash is considered much less risky than holding stocks or bonds. As the researchers put it, while this short-term deviation from the target provides some relative protection from market downturns, it does so by sacrificing some potential for greater portfolio gains. Dollar cost averaging is essentially betting that the market will crash over the dollar cost averaging period, which means that you're trying to time the market. If, as an investor, you feel uncomfortable with the risk associated with your current asset allocation and feel the need to dollar cost average, you may be better placed reducing your portfolio's overall risks. You could generally do this by increasing the allocation of bonds and reducing the allocation of stocks. This would protect you from making poor decisions during market downturns. Ultimately, deciding whether to use dollar cost averaging or lump sum investing comes down to your risk tolerance and your ability to stay invested during market downturns. Lump sum investing is more likely to give better results, but if you're an emotional investor that will panic and sell during a market downturn, then you should consider using dollar cost averaging. And with that, make sure to subscribe to the channel and follow us on Instagram at iQinvesting UK for more stock market related content. If you found the video useful, make sure to smash the like button and share it with a friend so that they can learn about dollar cost averaging too. Do you use dollar cost averaging yourself? Let me know in the comments below. As always, thanks for watching.